What I make is it's very noisy and confusing, which markets usually are, but I think things are a lot less negative than our brains or the media would have us believe. And when you look at, in the US, unemployment at a 50-year low, CPI inflation running at about 2.2% annualized, and the consumer resilient, I think the only weak side of the equation there is the business sentiment and industrial production are down because of the trade war. But on balance, I'd say it's a healthy economy, and that's the most important thing.
A lot has been made, of course, of the inversion of the yield curve, and we again saw that ever so briefly occur overnight. This, of course, big predictor for an upcoming recession. What do you make of that? Because there are some out there that are saying conditions, as we've seen them when it comes to low interest rates, what the bond market's actually doing, actually has never happened before in history, given the fact that we do have these record low interest rates when we're coming towards the end of this big economic recovery. So what do you make of the inversion of the yield curve?
The way I would say it very simply is that there is always a lag effect between the inversion and the recession, and depending on which yield curve you're looking at, if you're talking about the 2-year and 10-year, the average is about 20 months. I would just say, wouldn't it be odd if we didn't have a recession around 2 years or 20 months from now, because we've been in a very big economic upcycle for over 10 years, and they don't usually last this long. So I would be surprised if we don't have a recession 2 years from now.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now, to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.